Ethereum is about to ignite its biggest rally in years, and I'm personally loading up, not just on ETH, but also on 5 Ethereum altcoins that I believe are primed for explosive growth. Institutions are lining up, political tides are turning, and massive capital flows are quietly setting the stage for the most hated rally we have seen in years. If you think Bitcoin's run was impressive, wait till you see what Ethereum has coming. But the real question is, are you prepared for what happens next? For the first time in months, I'm actively deploying capital into select altcoins. But first, I'm focused on ETH and the Ethereum ecosystem because I believe it offers one of the best risk-reward setups that we've seen in years, given everything happening behind the scenes. In this episode, I'll break down exactly why these ETH-linked projects stand above the crowd and how this moment could set up the most powerful altcoin rotation in the market that's led by ETH. And I am deploying, I'm literally deploying almost the rest of my dry powder into this strategy that we talk about today. So let's get into it. If you've been in crypto, which most of you guys have, and if you haven't, welcome. It's not too late to be here. You guys have seen the memes. You know, Bitcoin's grabbed the headlines with recent all-time highs, while your crypto Twitter timeline has been making a laughing stock of ETH. But something even bigger is brewing in the shadows. I think that will all end soon, and even the biggest ETH haters will have to admit that they were wrong. We're about to see the most hated rally in crypto, and people, we love hated rallies, and we love to be on the right side of those hated rallies. If you don't know what a hated rally is, it's when everyone thinks that something just shouldn't be pumping, like when everyone says, oh, Solana's gonna replace Ethereum, whatever. And Ethereum sucks, it's slow, it's expensive, it's blah, blah. And so people don't buy it, and then it pumps, and they just are pissed that it's pumping, and this is a hated rally. But think about this. BlackRock, the titan managing over $10 trillion, just started pouring millions and millions and hundreds of millions of dollars into Ethereum ETFs. Well, Bitcoin is digital gold. They see ETH as a productive asset. Unlike Bitcoin, Ethereum can generate real yield through staking, DeFi lending, and tokenization of assets like real-world treasuries and stablecoins. Ethereum has become the backbone of the new financial internet. In fact, Ethereum ETFs have consistently seen positive inflows nearly every trading day for 2 weeks, highlighting the institutional appetite. Combine this momentum with announcements from Ethereum Foundation about their next major upgrade, like Fusaka and Glamsterdam, aimed at scaling Ethereum massively by late 2025. And you start to see why Wall Street is quietly making its moves right now. But here's what most investors are missing. Before we dive into specific altcoins, let's get real about why I'm spotlighting Ethereum right now and why this is the exact moment to be paying attention. Right now, the Ethereum Bitcoin charts is flashing signals we haven't seen in months. Miles Deutscher, good friend of mine, pointed out that this is the most constructive price action for ETH against Bitcoin in a long time. Bull flag, RSI reset, however you want to slice it. This is the kind of technical setup that's historically front-run the biggest rotations into the Ethereum ecosystem. Whenever ETH starts outperforming Bitcoin on the charts, you know capital is about to flow downstream into the rest of the ecosystem. We've seen this happen cycle after cycle after cycle. It's the same story playing out. It's easy when you know what to look for. But it's not just a chart. What makes Ethereum stand out is trust. We're talking about a network that's been battle-tested year after year with zero downtime and a security track record that institutions can respect. There's a reason why the world's largest asset managers are choosing Ethereum to build their next generation of financial products. Solana and Avalanche and the other so-called ETH killers or alt layer ones, they might have their moment, but none of them can match Ethereum's reliability, decentralization, and sheer market trust. If you're a TradFi heavyweight or a billion-dollar fund, you don't gamble on uptime. The conviction goes even deeper on-chain. Fresh data just dropped. The percentage of ETH staked has hit an all-time high. Over 28.6% of the entire supply is staked on the Ethereum protocol. What that really means is simple. More ETH is being locked up and taken off the open market than ever before. As regulatory clarity pulls in new institutional players, that supply crunch is only going to get more intense. You can feel the squeeze coming. And when you look at the net bridge flows on Artemis, it's clear that smart money keeps coming back to Ethereum cycle after cycle. ETH leads net flow among all chains over the last month and 3-month timeframes. If money talks, then the message is crystal clear. So when people ask, why cover ETH now? Why not Solana or whatever's pumping this week? Well, ETH is pumping this week a lot, actually. The answer is right in front of us. Breakout technicals, record staking, relentless on-chain demand, and a network that's weathered every storm. That's why I'm loading up on ETH and why I think this is the core play for what comes next. The biggest financial players are building ETH positions with purpose, treating it as an essential infrastructure for tomorrow's markets. Major institutions are integrating Ethereum into long-term strategies, turning it into the foundation for a new breed of financial products, underpinning everything from stablecoins to on-chain credit and payment networks. Regulatory momentum is adding fuel to the fire. In a landmark speech, the SEC chairman Paul clarified Ethereum staking is not considered a securities transaction under current federal laws. This is a major shift from the previous regulatory regime, which practiced regulation by enforcement or cast a dark cloud of uncertainty over staking. This is huge. And this was what my speculation was the second I saw this, was now institutions like Vanguard, who if you've been watching the videos for a long time, or even if you haven't, Vanguard said they were not going to participate in Bitcoin ETFs. Why? Because they prefer products with passive yield. Now Ethereum is one of them. So will Vanguard enter the game? We shall see. And for the first time, exchanges, custodians, and institutions have a clear guidance to begin offering staking-related services. When these products hit the market, they have the potential to unlock an entirely new wave of demand from investors who have been waiting for yield, security, and simplicity in one package. The play for smart money is to get positioned early. This is why asset managers are lining up for direct ETH allocations and new institutional-grade products tied to Ethereum, knowing the environment is shifting in their favor. And if you guys live on crypto Twitter, then you've probably heard these kind of things. Ethereum's slow, Ethereum's expensive, Solana's cheap, Solana's fast. No one wants to use Ethereum anymore. But I'll tell you guys, this is coming from the words of crypto natives, people who didn't deal in traditional finance, who weren't sending billions and billions of dollars from business to business, bank to bank, country to country. If you're used to those kind of traditional rails, Swift, other payment rails, banks, wire transfers, so slow, so expensive. ETH is magic compared to those traditional legacy financial rails. So no, ETH is actually cheap and fast compared to what TradFi has been used to. And this is why, this is my core thesis of ETH as a bullish asset, because it is cheap and fast compared to TradFi. And the most important thing when you're dealing with all of these huge amounts of money, billions and billions and hundreds of billions and eventually trillions of dollars, you need the most battle-tested network that offers smart contracts and programmable money. That is Ethereum. And the best evidence of this heightened demand is the recent Circle IPO. It was oversubscribed by 25 times. We covered this in previous episodes, and it shows just how great the institutional demand for stablecoins are. Since going public, Circle shares have surged to a valuation of over $25 billion, a clear sign that Wall Street is only getting started. With Ethereum's financial revolution, Ethereum has evolved. What started as a tech experiment has grown into the core settlement layer of the DeFi revolution. The world's largest asset managers and payment firms are building on Ethereum. They love its programmability and the fact that it offers direct access to real-world yield, transparency, and liquidity. Tokenization is the unlock. Circle's USDC, now with billions in reserves, is just the tip of the iceberg. Apple, Google, Airbnb, and X are all exploring stablecoin integrations, pushing the stablecoin market toward a $1 trillion milestone. Every dollar issued, moved, or saved through these new rails creates demand for Ethereum block space and security. As these flows grow, so does the need for compliant, scalable infrastructure, something Ethereum and its layer 2s have delivered. Major upgrades like Fusaka and Glamsterdam enable high volume settlements for everything from corporate bonds to on-chain lending protocols. With regulatory frameworks solidifying in the US and Europe as a global appetite for digital dollars, Ethereum's position as a backbone of the stablecoin and real-world asset markets has never looked stronger. When Ethereum pivots, an entire ecosystem can ignite. That's why I'm laser focused on a handful of blue chip DeFi protocols, each one built on real adoption, cash flow, and institutional grade design. Let's break down these standout projects one by one so you know exactly what sets them apart and where I'm putting my own capital. And remember, the rotation of capital historically has always been Bitcoin to Ethereum. We're seeing that rotation now to major caps. So we always want to try to say one shift ahead. Then from majors, we go down to large caps, and then we go down to mid caps. And then toward the end of the year probably is when we see these low and micro caps start to go absolutely parabolic. That's where the 100Xs come, and we will cover that stuff when the time is right. But what we want to do is we want to say one step ahead of everybody else. And that's why we run this show methodically as we go up the risk curve. We will bring you guys. And today we're going to talk about these DeFi products on Ethereum, because that's how I think the majority of capital is going to go. And so if we believe DeFi, and we saw Paul Atkins also talk about DeFi being able to exist and allowed to operate within the United States, along with self-custody, was a huge announcement. And that's why I think that these next altcoins stand to gain a lot over the next 6 months. I'm talking about anywhere from 3 to 20, and the last one that I'll talk about, potentially even a 50 plus X. All right, let's get into these altcoins. So the first one is Curve Finance. Think of Curve as the backbone of stablecoin liquidity in crypto. Curve's deep, low slippage pools allows hundreds of millions of dollars in stablecoin efficiency. Low slippage is vital for getting the best exchange rates when you swap. No nasty surprises on price, even for huge trades. That's why institutions and protocols use Curve as a foundational layer. And we're talking about versus other things. Like you can't use something like Uniswap to swap hundreds of millions of dollars of stablecoins efficiently, not like you can in Curve. And the reward system for Curve is really what makes Curve a powerhouse. As a liquidity provider, you earn both trading fees and CRV tokens. Stake those Curve tokens as VECRV to get a share of protocol fees and boosted yields. VECRV just means you're locking up your tokens for a set time to earn extra rewards. Kind of like putting money in a high interest savings account, but way more interest than traditional finance. Many blue chip pools on Curve offer a conservative 10 to 20% APY after protocol rewards and boosts. And more advanced users, leveraging integrations like Convex or Cross Curve, have even reached triple-digit yields in the right conditions. Those kind of yields are unheard of in TradFi, way better than what you get at local banks, of course. It's night and day, right? And now Curve is becoming deflationary because more Curve is being locked up than emitted. So the token's getting scarcer as adoption grows. For me, Curve is an income engine, a bedrock for stable, sustainable DeFi yield as institutional flows ramp up. Next is Aave, the protocol I call the institutional credit desk for DeFi. Aave now secures over $25 billion in value, which is more than some regional US banks. In fact, Aave's active loan book is now bigger than the savings balances of major neobanks like Revolut. That's real scale, and it's why Wall Street will take notice. When you deposit stablecoins or blue chip assets into Aave, you're lending to a global market and earning interest from borrowers, usually 3 to 6% APY for stablecoins. If you stake your Aave in the safety module, you can earn an additional 5 to 10% yield, plus get a voice in the protocol's governance. The safety module is like a decentralized insurance fund. It helps protect the whole system, and you get rewarded for backing it. Aave is built for institutions. It has real-time risk dashboards, transparent loan books, and a robust over-collateralization system. That means every loan is backed by more collateral than is being borrowed. So the protocol stays solvent, even if some loans go bad. Well, they can't actually go bad because of the way that the collateral works, but you get the point. This is the kind of infrastructure TradFi respects, And it's a kind of infrastructure that all the centralized competitors are now modeling after. But unlike centralized competitors, you don't have to have your ID, doesn't ask you who you are, doesn't need to know anything, doesn't take any time for loans to get approved. You can get a loan in as little as 12 seconds without any questions. And I've been using Aave for about 4 years, and I use it a lot. I have a lot of money in Aave, and it's been so useful. It's the most useful DeFi protocol for me. And that is why I'm the most bullish on it. And if you haven't tried Aave for yourself, go try it out. Play around with it. Ask ChatGPT o3 how to use Aave for a situation like yours. Tell ChatGPT o3 what your financial situation is like, how your portfolio is, and how you might be able to use Aave to improve your financial situation, improve your leverage a little bit. Just play around with it. It's an incredible protocol. And what excites me right now is Aave's new umbrella buyback program, actively shrinking token supply using protocol profits. And with the launch of GHO, Aave's own stablecoin, the protocol is set to capture even more stablecoin flows as regulation opens up. This is why I think Aave is in the best position to channel the next wave of global institutional capital. Okay, next up we got Aerodrome, which is dominating Coinbase's layer 2. Since launch, Aerodrome has captured over $1.2 billion in TVL, more than half the liquidity on Base. And here's why. Aerodrome uses slipstream concentrated liquidity pools. So every dollar is always working, and emissions reward where real trading happens. Concentrated liquidity just means liquidity is focused where most trades take place. So swaps are more efficient and returns are higher for providers. Governance is driven by VE Arrow NFTs. Lock your arrow and you get to direct emissions, earn all protocol fees, and claim extra bribes during voting epochs. VE Arrow NFTs are your governance keys. They give you a say in how rewards are distributed and let you earn a bigger slice of the pie just for locking up your tokens. The annualized protocol fees topped $160 million, and the market cap to revenue multiple sits around 3.7x, which is what you'd expect from a breakout fintech stock. That multiple is a quick way to see how cheap or expensive a protocol is versus the money it's making. What jumps out for me is the institutional connection. Coinbase's CBBTC sees $100 million in traded daily on Aerodrome, and now CBXRP and CB Doge pools are live and incentivized. Every new CB asset Coinbase brings online increases the flow, and Aerodrome captures all of it. With 30% of the fees going straight to buybacks and max locks, the protocol is becoming a true deflationary powerhouse. Okay, fourth up, let's talk about MakerDAO, now officially rebranded as Sky, and its ecosystem. These are the protocols currently bringing real-world yield, regulation-ready lending to Ethereum. The Sky platform now holds $5.27 billion in assets, with nearly half allocated to tokenized US Treasuries and other regulated RWAs. Spark's blended RWA yield sits at about 4.5%, and Sky is paying out $250,000 a day in buybacks and dividends, funded by protocol revenue. Staking with Sky can bring in 25% APY, and the market cap here is still a fraction of what you see in TradFi for platforms with this scale. The innovation doesn't stop at lending. Products like SUSDS and tokenized treasuries give institutions a clear, compliant path to on-chain yield. As regulatory clarity spreads, Maker, aka Sky, is a go-to for capital seeking both transparency and real returns. All right, and fifth, guys, fifth is asymmetry finance. And full disclosure, I am an investor here. Also, by far, this is the lowest cap project I'm speaking about today. It doesn't even qualify in the major caps, but I think you'll understand why I'm mentioning it when we talk about it a little bit more. So that means that it comes with the most risk, but in my opinion, of course, also the most potential upside. Asymmetry is setting the standard for a new breed of decentralized yield index. It has $27.6 million in TVL currently and a hard cap of 51 million tokens. ASF, or Asymmetry Finance, delivers robust, diversified exposure to Ethereum staking yields and beyond. ASF's SAF ETH and AF ETH products let users spread risk across top liquid staking tokens. The AF CVX product is a game changer. It delivers 25% APY on Convex, but with instant liquidity and no long lockups. And now with its stablecoin USDAF, it's enabling fixed rate borrowing at extremely competitive yields. That's exactly the kind of stuff that Wall Street loves to hear. And let me tell you something else about their stablecoin. They partnered with Ampleforth, which for years has been my favorite stablecoin. Why? Because it's not really a stablecoin. It's called a flat coin. And if you hold your value in this stablecoin or this flat coin, it actually protects you against inflation. Because the way that this stablecoin works is it adjusts the peg value along with CPI, or Consumer Price Index. So the value of these stablecoins is the 2019 dollar when it was launched, and it adjusts for inflation. So holding your value in that stablecoin will not decrease your purchasing power like it will holding in regular dollars or other USD denominated stablecoins. It's by far the most innovative, and for the entire time it's been around, it always has maintained essentially right around where the point wants to be. An inflation protection flat coin, they're called. Really, really innovative. And the protocol's governance is fully community driven, and every dollar of revenue is distributed back to VEASF lockers, basically staked ASF. What really stands out though, investor backing from giants like Fidelity, Frax, and the founders of Convex. And here's a little perspective. Fidelity has only backed 2 stablecoin projects in all of crypto, Athena and Asymmetry. If Asymmetry ever catches up to where Athena is trading now, you're looking at about 100x potential. And even if it only goes half of that, you're talking about 50x, right? And Athena is still going to do another probably 10x from here. So the upside, if this thing catches on, and that's a big if, but if it does, asymmetric bet. And that kind of asymmetric upside is rare AF. No pun intended, but it's exactly why ASF is where I'm looking for the next leg of sustainable DeFi returns. And if you want an index fund for on-chain yield, ASF definitely deserves some attention. Okay, guys, those are the 5 altcoins that I'm rotating into. Now, let's go back to Ethereum for a second. This year's most powerful catalyst for Ethereum and its entire ecosystem are coming from DC. In the halls of Congress, 2 major pieces of legislation are lining up to change the regulatory landscape for crypto. We've got the Genius Act and the Clarity Act. The Genius Act, now heading for a Senate floor vote, aims to lay the groundwork for the first truly regulated, federally recognized stablecoins. Meanwhile, the Clarity Act is working its way through the House committees, harmonizing the legal framework that define how digital assets are treated by the SEC and the CFTC. Together, these bills promise to provide the legal certainty that institutional capital has been waiting for. Why does this matter, you ask? Analysts estimate that the passage of these acts could propel the stablecoin market from $250 billion to over $2 trillion. It's a lot of money flowing into our space. And that scale would not only unlock a torrent of new demand for US treasuries, but it would push trillions of dollars of new liquidity into our blockchains. Liquidity that needs a secure, compliant, and scalable settlement layer. In other words, you got it, Ethereum. Big banks, global asset managers, and tech giants are already circling. If these laws pass, we would see a generational transfer of value and a new era for on-chain finance. One where protocols built on Ethereum become the backbone of the global money movement. So with all this momentum building, how should you position yourself? Now, I'm not here to give financial advice, but I can share with you how I'm playing this market and what's in my own playbook. First, Ethereum is one of my must-have core holdings. With sustained institutional inflows, major upgrades on the horizon, and regulatory clarity closer than ever, ETH is now the default asset for anyone looking to ride the next wave of global liquidity. This is not the time to overthink or chase shiny new coins. Ethereum's combination of real yield, network security, and the sheer scale of its ecosystem puts it in a class of its own. Now, guys, one thing I will note is Ethereum itself doesn't just generate yield sitting in your wallet. So let me know in the comments below if you guys would like me to do a show on Ethereum liquid staking derivatives and liquid restaking tokens, because this is a way to get exposure to ETH upside while simultaneously generating between 3.5% to 5% or more of yield on your Ethereum annually. Let me know in the comments below if you guys, because I'm digging into this and I'm thinking about allocating a huge amount of my Ethereum holdings into these restaking tokens. So of course, Ethereum is the blue chip here. right? And next, I'm allocating directly into the most resilient and cash flow positive blue chip DeFi products built on Ethereum. Curve, Aave, Aerodrome, Maker, now Sky, and less so, but definitely some to asymmetry finance. Each serve as a strategic function in this new financial stack. By holding a diversified basket of these protocols, I get exposure to stablecoin growth, real-world asset tokenization, and the ongoing demand for decentralized, compliant lending and liquidity. All of these things are the most talked about things in DC right now. Of course, you need a basket of these. Finally, I'm keeping some dry powder for tactical, high-conviction plays that will pop up, and we will cover them. This might be an emerging L2, a narrative-driven project with surging fundamentals, or simply cash on the sidelines to capitalize on volatility when the next headline shakes the market. The point is to stay flexible and disciplined, so I never feel forced to FOMO or sell at the worst time. Everything I'm sharing comes back to one simple principle: stack productive assets, understand the macro forces in play, and always leave room to adapt as new catalysts emerge. The next leg of this cycle will reward those who act early, think strategically, and build real conviction in the best protocols. Right now, we are living through a true turning point in the story of money. Ethereum is quickly becoming the backbone for a new financial system that reaches from Wall Street to Main Street, from global institutions to everyday savers. While headlines focus on Bitcoin's all-time highs, the real smart money is quietly building positions in ETH and the blue chip protocols that anchor its ecosystem. We've never seen this level of regulatory momentum before, ever. This is phenomenal. And we see institutions stacking ETH hard. The SEC has given the green light for DeFi innovation, and Congress is moving to legitimize stablecoins and digital assets in a way that could open the floodgates to trillions in new capital. Even the world's biggest tech firms are preparing to integrate stablecoins, and institutions that once ignored DeFi are now racing to lock in yield, transparency, and programmable money that Ethereum delivers. We're truly living through a paradigm shift. The foundation for the next decade of global finance is being built right now, block by block, protocol by protocol. Those who act early and build conviction in productive, compliant, and truly decentralized assets will look back on this era as the greatest asymmetric opportunity in their lifetime. I'm not saying that lightly. So as you plan your next move, remember, history rewards those who see the writing on the wall and step into the new order before the crowd. Stack your conviction, educate yourself, and position wisely. And remember, FOMO is a mother effort. So that's why we see a methodical approach on this show. If you're not subscribed to the channel, make sure that you do so, guys. And if you've gotten a lot of value from this episode, do me a favor and destroy that like button. Drop your own thoughts on the comments below. And as I mentioned earlier, I made a video on Circle's recent IPO. And if you really want to understand how much Wall Street demand there is for a stablecoin infrastructure, check out this next video. And remember to stay sharp, stack your sats, and now a little bit of Ethereum and these other blue chips. And I'll catch you guys in the next one. See ya.